So welcome to today's webinar. My name is Walter, and we're going to talk about some support and resistance here today. So what I want to do is I want to go over 5 basic concepts, and what we'll talk about are the different types of moves off of support and resistance. And what I mean by that are, well, there's essentially 2, right? Either the market's going to go through the level and continue onward, or it's going to rebound off of it and go in the opposite direction. So we're going to break those down and look at two different ways of looking at both of those. Then we're also going to look at more common types of rebound. So when we talk about support and resistance, there are 2 basic things. One is that the market goes to a support and resistance level and then breaks on and goes further. It's like a breakout. That's what we call a breakout as traders. And then there's the other one, which is we call the rebound or the reversal. And we'll talk about the most common type of rebound, how to anticipate rebounds. We'll talk about common breakout patterns, how to anticipate those, and fake outs as well. And then we will also talk about using crowd data, specifically retail Forex data and numbers, to anticipate whether or not you're going to get a breakout or a reversal. Okay, hello Pat Cats, welcome aboard. So as you probably know, my name is Walter Peters. I wrote the book Naked Forex. I'm a full-time Forex trader. I trade support and resistance. In the book Naked Forex, which I know many of you have read, it has simple patterns that I use. A lot of these patterns came from Bulkowski. So if you read Bulkowski's book called The Encyclopedia of Chart Patterns, that's where I got a lot of my ideas, and it kind of modified them from there. And I've gone beyond that as well over the last, I don't know, 6 or 7 years since I wrote the book. So let's get into support and resistance here, because that's why you're here. And let's talk first about the first type of move, which is kind of like the ideal sort of move. And at the end of the session, obviously, fire away your questions about any of the live charts. Happy to have a look at those and talk about the trades that I'm in right now. Okay, so let's get into it. So there was a trade that I took recently, and it was right here. Okay, so let's talk about this one, because this is what's known as the hard bounce, and it's kind of rare, but it does happen. Now let's back it up. Okay. All right. So let's talk about how this happened. This is the New Zealand dollar 4-hour chart, and I took this trade back in, looks like it was the end of Feb. It took a couple of weeks to unfold, and I'll share with you what happened. I'll also share with you what I did with a quarter of this position, but a lot of traders wouldn't do, and would consider that to be a mistake or an error or whatever, but I don't really look at it that way. So what happened was the market had come down to this level here, the 72 level, and printed a couple of nice wiki candles on February 8th, in fact, and then went up. And so when it was coming down here, I was looking at this and I thought, you know what? When it gets down here, I'm actually going to go ahead and buy, and I'm going to buy down around, I think it was 71.95 or 71.85. I can't remember. So I think it was 71.95 that I went long. I had a standing order and I had a 50 pip stop. So what that meant was it could go as low as, because the low on this candle is 76. So I think if it was 95, so 95 would have put it down at 45. It would have stopped me out had it gone as low as 71.45. But remember, the previous low over here was 76. So that would have been, a good 30 pips lower than where it was the first time. So I felt pretty good about this. Now, this style of trading is not the style of trading that I typically do, but I've been doing it more and more over the last last 4 years, really. And the reason why it's interesting is because it allows for a really high reward to risk ratio with your trades, but it doesn't necessarily allow for a good win rate. And so you really need to eke out higher R trades. Is everyone familiar with R? The concept of R from Van Tharp? So the concept of R is simple. It's just simply that when you take a trade, you grade the exit based on the initial risk. So the initial risk for this trade was 50 pips when I went long at 71.95, which happened right here on this candle, and I had 50 pips of risk, and then we'll talk about the exit on this. But that's the way that that's the way that a lot of traders will grade trades, is based on R. So how many risk units did you make on the trade, or did you lose? Did you lose half an R? So my initial risk is 50 pips. I could have lost 25 pips, and that would have been negative 0.5 R. I could have made 300 pips. That would have been 6 R, and so forth. Right? I didn't, but spoiler alert, I didn't. But that's one way to look at it. So this style of trading is when you're looking for a hard bounce off of a level, and typically, this style of like if you wanted to look at it from an indicator point of view, which is not necessarily my go-to. I don't really like doing that, and I don't think you need them. But this would be the kind of trade where traders are going, wow, it's on the other end of the other edge of the Bollinger Band, or it's the RSI is saying it's way oversold, or whatever. The moving averages are crossed and it's moved away from the moving averages and it's due for a rebound or whatever. So that's the kind of trade that this is. It's sort of a it's gone really far and it's going to pull back. Now, this is most comfortable for most traders. And we're going to talk more about this in just a moment when we talk about the crowd. But most traders enjoy trading against the trend. This was in a pretty strong free fall when I placed the order. It's always kind of scary doing that, but it turns out that most traders prefer to try and pick their turning points rather than to ride the trend. And we'll see data that indicates that this is the case in just one moment. So this was a long trade here. You can see it started to print another wiki candle here, and then it made one of these things. It's like, oh no, is it going to keep falling lower? No, and it went up. Now, I was looking for a minimum, so it pulled back down here, and then it went higher again, I believe. Yeah, I was looking for a minimum of 3R, so 150 pips was really the minimum I wanted, and I got out, I believe, on this candle here. 75% of the trade was dumped here. So I think it was just under 150. I think it ended up being like 148 pips or 147 pips, something like that. But I was definitely on this candle. And then what happened? I think it went a little bit higher. Yeah, it went a little bit higher on me. And then it pretty much turned around. Now, by this stage, the stop loss was moved to break even. So the risk was gone. Unless, of course, you get gapped over the weekend or something crazy happens. But so there is definitely risk, even when you move to break even, there's always risk, right? There's a risk that your broker goes bust. There's lots of risks involved, obviously, with trading. So at this stage, I was kind of hoping that I would get an additional, remember I got out here, an additional, 1.6R or something like that, at 1.7R if it was to get up here, because so that would have been 4.7 or 4.6R or something like that, if almost 5, not quite though, if it would have come up to this level. So that's what I was holding out for. And in fact, what ended up happening is it just fell down and boom, hit my break even stop. I think not that long ago. The end of the week. I think it was Friday. Anyway, doesn't matter. So that's an example of like a blind sort of, I'm just going to play the support and resistance. Now, let me point out what the critical thing about this trade was. The critical thing about this trade were these two wicks. Now, I would call this a hard bounce off this level. I would count. So zooming in kind of on these two candles, and I want to make sure you can see them. The thing that I would call this trade is a really hard bounce off of this support level. Now, the reason why this is a support level is not because of this bounce. The support level was clear long before this bounce, in fact, and you can see that all the way back here where it found resistance, finally broke through, and even back here where it touched it and then it fell, going back to this level here where it kind of bounced support, finally broke through and retouched on the way down, found resistance again. So this is a long stand. There's a kangaroo tail there, or nearly a kangaroo tail there. Lots of support here. So it wasn't like, it bounced back here, so I'm going to go ahead and assume it's going to bounce here. No, this was already a level, regardless of what happened last time. But the most important thing to me was what happened last time. Whoa, sorry. That was the trade. Last time being these candles. So what's interesting about this is what I would consider to be just a really hard bounce, almost like a V formation. I call them bend trades when you see a really strong bend on the line. Here's another one, here's another one, here's another one, here's another one. You get these really, the market pushes hard off of support and resistance. Now, some people would look at this and say, Walter, no, that's not what I would call it. That would be a double bottom or a lazy bottom. I talk about the whammy trade in the Naked Forex book, and this could qualify as that because technically you have one touch on the level and then you have another one here. So the first touch is lower, the second touch is higher, and the trade would be on the whammy trade. The trade would be buying off the high of this candle. Stop loss goes the stop loss goes below this low here. So it would be buying here. Now the amount of risk on this trade is much greater because, well, it's 56 pips or whatever, 57 pips on that one because the stop loss goes below that first low. But I think that although you could call this a whammy bottom, what intrigued me about this level was how these candles got really wicky and it moved away from there rather quickly. Notice that it never, like the lowest close was this candle right here. The lowest close was 71.97 and it wasn't even close. After that, all of the closes were much higher than that, all of them. And then what happened over here was interesting. The lowest close was 71.96. So technically it was 1 pip lower, but it was really, really close. And then again, what did it do? It just moved away rather quickly. Now it did again pull back, just as it pulled back here, but it didn't close anywhere near where the low close was over here. So that's another thing that I want to point out is if the first style of rebound off support and resistance is what we call a hard bounce or a bend trade. And typically the two ways that you will identify these, and I'll write this down for you actually, let's do this right now. Number one is that you will see a strong V on the line chart. So line chart equals strong V. Strong V just simply means, a strong V formation simply means that you get a really strong close off of the support resistance level, and that makes it move really hard away from the level. And then the second thing is you've only got one close on the zone. So what I mean by one close on the zone is only one candle closes on the zone, and all the other candles close away from the zone, clearly away from the zone. And when we talk about breakouts, you'll see how that will differ quite a bit from these rules. Is everyone clear on this? Does this make sense? When I say that a hard bounce has two really defining characteristics. One is that you get a really strong V formation bounce, and two, that you're only going to really typically see one close on the zone, and that's it. After that, the rest of the candles will close far away from the zone. So obviously on this formation right here, the one close was this candle right here. This little orange kangaroo tail looking candle. That's it. From there on, the candles moved away. All right. So when I take a blind trade, which by the way, I actually took another one. I'll share. I'll just go to the other one, unless somebody has a chart that we want to use. I don't want to cherry pick charts here. I'm happy to use your chart. But yesterday I took another trade. It's kind of well, this one's a little bit more complex. Let's get into this one later. I don't want to confuse the issue. So I took a trade, my stop loss. So really the 1 hour chart is kind of the easiest way to see this, but basically I'm in this trade right now. And what happened was, the low on this candle is 58.98. I put my stop at 58.95. I was originally going to put it at 58.98. I just put it 3 pips lower, and I went long as the market was falling up, down against this level. And I was assuming that we were going to bounce off this level. Now, it did, and it looked really ugly falling down here. But I'll show you the clue that I used here, and it wasn't. The main thing I used here was the fact that this was a strong level, and I knew it was from all of these touches over here. You had triple touches, 1, 2, 3. And number 2 is I knew what the crowd was doing. So I'll share that with you in a moment. But I just want to share with you another blind entry. Like, there's no reason why I should go long here. Like, technically, in terms of formations, on the 4 hour, there's no signal there. On the daily, there's no signal there. On the 1 hour, you could have made and the one argument that I would say, okay, well, maybe, is you have kind of this bullish flag. The issue, though, is that the market's going down. It's not going up. So if you had a bullish flag like this, when the market was going up, I would say, okay, yeah, fair enough. That's a bullish flag. But actually, the market was going down. So this is more of a clue that the market was ready to reverse. So now what we should see here, if we're going to see really strong bullish candles, is we should see some more bullish flags where the market does a little move like this, where it kind of goes down a bit, and then eventually it breaks out of that downward move and makes another strong bullish candle upward, right? Another trend candle upward. So we should see more of these as the uptrend continues. Now, if we see a bearish flag somewhere up there, then maybe we know that, okay, the structure's changing, the market's changing, and it's going to start to reverse and go lower. But I want to get more into this trade in a moment when we talk about other things. So are there any questions? Does this make sense in terms of the I just want to make sure that I don't have any questions here in terms of the hard bounce. Hard bounce making sense? Okay, cool. I want to keep going. All right. So the most common rebounds, however, are not the hard bounce. The most common rebounds, in other words, reversals that you're going to see, are double tops and double bottoms. They are far more frequent than what you would call a hard bounce, where it just kind of V bottoms or V tops off of it. So, for example, let's see here. Actually, I just want to pick a chart at random and see. Okay, well, here's one on your daily pound. So here's your daily pound. You see it went up, it pulled back, and then it went up again, and then it fell. So double tops are very common. Double bottoms are very common, and V bottoms, V tops are very, very uncommon. You don't see them very typical. They're not very typical at all. Let's see if we can find. Here's another one. Here's a V. Here's a double bottom. So it touched, went up, touched again, and then boom, it was off to the races. So this is the most common one. So why is this important? The reason why this is important is because when you see the market get to a level, like for example, a good example of this was the Euro Aussie. When I saw it come down here and bounce, I kind of expected it to go up and then come back down here and bounce again. Now, this was a really weird formation in the way that it kind of flagged down this channel and then kind of bounced off of this. That's not typical at all. I would say that's not typical. Typically, what you would see is a bounce. It would come up like this, and then it would come back down here, and then it would bounce again, and then it would just go up. It doesn't really matter whether the second bounce is higher or lower than the first bounce. So let's talk about this quickly. If the second bounce is, we're talking about a buy now, obviously a double bottom, not a double top. If it's a double top, we would reverse these rules. But for a double bottom, if the second touch, the second bounce, is higher than the first bounce, and that's a whammy trade. If the second bounce is lower, it makes a lower low than the first bounce, what we really want to see here is we want to see the candle close above the lowest candle close over here. Let me state that, and we did not have that in this case. Let me state that another way. When you see the market make a double bottom, if the second touch is not higher than the first touch, then what you really want to see, the market actually make a move to where the first touch has a close that is lower than the second touch's close. So when the market comes down here and goes lower and takes out the low that was first made over here, makes a lower low, it should still close above the lowest close over here. So the lowest close over here is 59.31. We should have closed above 59.31 over here. We didn't. So that this is not a nice double bottom at all. It's not. The structure, but again, I took a blind trade. I wasn't waiting for any sort of really nice looking setup. So there you go. All right. So does that make sense? Are we all cool on that one? Following me on this one? Hopefully. Excelente. Sweet. Penny Ahmed. Okay, cool. All right. So let's talk about the next thing that I want to talk about. So the most common rebound is the double top and the double bottom. Occasionally you'll get the hard bounce or the V bounce. Often includes long wicks, a one close on the zone, and you see a really sharp move on the line chart. And then let's talk about the breakouts. So the most common breakouts, there's a couple of principles that I look for when I'm looking for a breakout. Number one, I just want to see if I can find an example of one. There was one on the pound New Zealand, but didn't really, well, yeah. All right, so this is an example of a typical bullish breakout, okay? This is what they look like. There's two really common ones with the bullish breakout. The first is where you see the market being pushed, where the trend line pushes it up against a support and resistance level, right? So that's what's happening here. The trend line, it's following the trend line, and I want to see at least 3 touches up there. Now, depending on how you draw the zone, you have a touch here, a touch there, and a touch there, whatever. You know, it depends on how you draw this. Probably I would draw it like this, something like this. But, you know, you want to draw it when it's doing this, not after it already does the breakout, right? But this is one that's just happened. So this is an example of what these look like. So what you have here is you have at least 3 touches on the horizontal level. It doesn't matter whether it's a bullish squeeze play. These are called squeeze plays, or a bearish squeeze play. What typically will happen, you'll have a couple, 3 or 4 or 5 touches on the zone, and then it returns to the trend line. It keeps making, in the case of the bullish squeeze play, it keeps making a higher higher lows as it follows the trend line. Finally, it breaks out, and then it'll bounce off the horizontal level one last time and then go up. If you have a fake out, what you will typically see here is a long-tailed kangaroo tail. So if it breaks out and then it closes right back down below the zone quickly, that's usually going to come in the form of a kangaroo tail, almost, or a bearish big shadow. But it's typically a kangaroo tail. I mean, you know, a bearish big shadow on one time frame is a kangaroo tail on a higher time frame, right? But you get the idea. So that's what I like to see in terms of the breakouts. Now, one of the interesting things about breakouts is that typically you will see the market touch the horizontal level multiple times in quick succession. So breakouts have this common element, these common elements. One is multiple quick touches, which is exactly what you have with the squeeze play. Multiple quick touches. The second thing that you have here is retouch on the other side. So in the case of an upside breakout, resistance becomes support. So that's what happened here. The market goes up, and then boom. The real key here was this bullish candle right there. That was the key. That was absolutely the key. When you see this really strong bounce off of that. So multiple quick touches, and then a retouch on the other side. Now let me share with you another very typical breakout pattern. This is, let's see here. Let me just, I don't know if we can find one here. Wow, that Aussie yen was a good one, wasn't it? Let's see here. Maybe a weekly. See if we can find a nice weekly. Well, probably weeklies. A lot of traders don't have the patience for weekly charts, but they're pretty fun indeed. Actually, our good friend the euro has been. Let's do this one. Let's get rid of all this stuff. And hey, actually, the euro is a great example of this. And I would be looking for a bullish breakout. So it hasn't happened yet, but this is what I'd be looking for on our friend the euro. Mr. Euro, sir. Okay. So when I draw the box on a pair, I need to have at least 2 touches on the bottom and 2 touches on the top. So we have 1, 2, 3 touches on the top of the box, 1, 2 on the bottom. So this one doesn't quite count. Depending on how you draw the box, you could make it fit, but I don't like that because I like these touches over here. So I would call this a near miss. So it's got 2 touches on the bottom, it's got 3 touches on the top, and so we would look for a last kiss trade here. This is, of course, is also in the Naked Forex book. If you haven't read it, I'll give you the rules right now. Basically, the market, the pair will break out of the box, and then it comes back down and bounces off the box with a nice bullish candle, just like we saw on the squeeze play example a moment ago, except it just does it off the box. Now, it doesn't have to go as far as I see here. And you really want to have a bullish candle in the box. It might only do something like this, you know. It might only do something like that and come and meander and come back down and bounce over here, whatever. The point is, it's got to spin several candles outside the box, not closing on the box. Closing above the box, and then boom, it comes back down, gives you a nice bullish candle. Put the buy order above the high. My stop loss goes in what I call the midpoint of the box. Now, midpoint of the box in this case would probably be about here at 2302 or so. Now, if the market bounces here and I go long, and then it fizzles out and comes back down here and a candle closes inside the box, a candle of whatever time frame I'm using to take my trade, I cancel my trade. I get out of my trade. And what that allows me to do is get out with a really, really small losers. So I might have, 214 pips of risk, but I might only have like a 48 pip loser or something like that. So I'm losing 0.3 R or 0.28 R instead of the full R. The emergency stop is the midpoint of the box, but usually a losing trade would end up, on a really bad losing trade, you'll lose the full R, but on most losing trades, you don't lose the full R, which is great. And a lot of traders love this system simply because of that rule. So this is another one. This is the breakout. Okay. We've talked about the hard bounce. We've talked about the double top and the double bottom, or the lazy double top, the lazy double bottom. We've talked about ghost peaks and ghost valleys, which are where the second touch is lower on a double bottom, where the second touch is higher on a double top. But remember, the close is critical there. The first close is the key. And we talked about squeeze plays. We talked about last kiss trades. Those are the common breakouts. And remember here, the key with the breakout is that the market typically keeps hammering the level. If it's going to rebound off the level, it will touch it once or twice and get away and never come back. If it's going to break out, it will almost always hit it again and again and again and finally crack, which I think is what's going to happen here on the euro. I think what we're going to see here, and I know there's interest rate announcement, right, on the USD. I think coming up in a few hours or so. I'll be asleep, but in the States, yeah. So when that happens, that's going to shake up the market. I mean, everyone expects, I think, the Fed to, in fact, raise rates, I believe, if I'm correct. But I don't really pay attention to a lot of that stuff, but I think I did hear that today. So I'm pretty technical in terms of my trading. But yeah, so you know, that's kind of, I guess, built into this. But the important point here is that when you see the market approach a level, you have to decide, is this worthy of a trade? And if it's worthy of a trade, it either means because it's showing that, yes, there's a reversal here, or it's showing that, yes, there's going to be a breakout. So that's how I look at support and resistance. I don't think that every time the market reaches support and resistance, there's a trade. But if it gives a nice breakout sign like a last kiss or a squeeze play, then yes, I'll trade the breakout. And if it gives a nice reversal like the hard V bottom or V top with the long wicks, then I'll go ahead and take the reversal trade, or a double top or double bottom, a whammy or a moolah or a ghost peak or a ghost valley. I will do that. Now, one other thing I want to point out here, and I promised you at the beginning that we would talk about this, and so we shall, which is that we are going to talk about crowd, my friends. This is, you go to fxjake.com/crowd, and it will send you here, fxjake.com/crowd. So this is how I figure out, and this is why I took that Euro Aussie trade. I'll just quickly go over this because I know we don't have a lot of time. And in the meantime, if you guys have any charts that you would like to see us look at, just go ahead and type the chart in the chat box. I don't want to run out of time here and not give you guys a chance to. So if you have any pairs that you want to look at from a naked trading point of view, I'm happy to do it, but type them in now. I don't know how much time we have, Adinda. I don't know how. I think we're pretty. Yeah. Okay. So let's go. So the way that this works is as follows. When these are retail traders. Okay. What do we know about retail traders? They take quick profits and they overall lose money, right? The reason why they lose money is because they take quick profits and they take huge hurtful losses. So, and what's interesting is retail traders use the gambler's fallacy. Now, my friend and I, when I went to, so I have a PhD in psychology, but when I went to undergraduate school, I went to a really good school, actually, it turns out. I lucked into that. And they helped us build up our resumes, so to speak, so that we could get into graduate school. And we had some really good professors. One of the things that you do to get into psychology graduate school is you do a lot of statistics. So we had a lot of statistics courses. And one of my statistics professors was a really funny guy. And my friend and I, my friend was really into blackjack, okay? He'd walk around with 7 different card decks and he'd be playing blackjack by himself. And he was trying to come up with some sort of martingale strategy where he would, double it down every time he had a losing hand and blah, 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 and all that. Now, of course, the reason why Las Vegas has limits on their tables is because of this strategy. And so he kept doing this, and he was trying to figure out how many losing hands he could have in a row. And it turns out that he could get about up to 10, 11, or 12 losing hands in a row, which meant you pretty much run out of money at that stage. And we went to our professor and we said, what if you did this? What if you just played blackjack, and every time you had a losing hand, you just double the next one? And he looked at us like we were crazy, and he said, that's the gambler's fallacy, which is every time you have one result, the other result's more likely. And it's also why when you go to Las Vegas or any casino, at the roulette table, they'll post up all the different numbers on the roulette, and they'll say, wow, they want people to look at it, and they go, wow, they've had 6 or 7 or 8 red numbers have come up on the roulette wheel, well, then a black one is much more likely to show up. So I'll bet on black now. Well, that's not the case. The case is if it's a fair wheel and a fair ball and it's a fair spin, it's always 50% chance on red and 50% chance on black. Or, you know what I mean? If there's, I know there's the 0 and the double 0 in the United States, which means it's not quite 50-50 because there's the green numbers, but you know what I mean. The point is, traders also operate on this. So when there's a trend, there's right now a nice bearish trend on the Aussie yen, and a lot of the traders are going, all right, I'm going to go ahead and buy the Aussie yen because it's falling and it's bound to turn around. Same thing with the Swissy and the yen. And obviously the same thing here with the Euro Aussie. So I knew that 70+% of which is my cutoff. I look for 70% of the traders to be on one side, and then I look to get into the other side. So if I look at the chart and the Euro Aussie is in an uptrend, then I know that if there's any sort of pullback, it's likely to be temporary. And that's exactly why I used the blind entry on the Euro Aussie. So here, let me just unpack all of this for you. The reason why I wanted to take a trade on the Euro Aussie was because I looked at the crowd and the retail traders, which again are losing money. We know this, right? They lose money because they try and fade these trends and they get steamrolled. So the Euro Aussie is in a downtrend. And by the way, I've been trading the Euro Aussie for a long time. It's been like this for weeks and weeks and weeks actually this year. As has the yen and the Swissy, but that's the Aussie yen's just kind of recently moved into that range. But the Euro Aussie has been in a really nice bullish trend, and I've been trading it quite a bit. And so when I saw the pullback, I said to myself, this looks like a pullback. And so what does that look like? Well, it looks a bit like this. So when we saw the market falling down here, and in fact, it was this candle, I think, where I put my trade in, or maybe it was this one, whatever. Yeah, it was this one. The market was falling. I went long here, not because there was any sort of double bottom or V bottom or any sort of really nice candle formation, but simply because I knew that this chart was in an uptrend. This was a very strong uptrend, and all along this uptrend, the retail traders have been shorting it, selling, and they're taking quick profits on every sort of retracement move. So the ones that were lucky enough to short over here took quick profit down here. The ones that were lucky enough to short it up here at resistance took quick profits down here, and so forth. Meanwhile, I've been going long. And so when I saw the market pull back to this level, which is on top of these highs, I said, oh, it's definitely going to bounce here and keep going higher because we know that the trend is probably still intact. Does that make sense? So this wasn't so much a the only thing that I said here was there wasn't really a candle formation. It was just that I said, look, this is a really lovely level of support, or likely to be support because it's been resistance in the past over here. So I would look for a bounce here. Now, who knows? This could end up getting stopped out, but I doubt it. I think it's at least going to get up to 60.25, and we'll see. We'll see what happens. But this is an example of a blind bounce off of support and resistance based on a trend, a support and resistance level, and knowing what the retail traders are doing. Any questions about any of this? Is this making sense? So we've talked about the two styles of bounces off of support and resistance, the hard bounce and the double bottom, the double top, the moolah, the whammy, the ghost peak, and the ghost valley. We've talked about the common breakouts, such as the squeeze play, and of course the fake out squeeze play, but the squeeze play and the last kiss. And then also we've now talked about how you can trend trade retracements based on what the crowd's doing. And it's pretty simple stuff. I mean, it's pretty powerful. Sometimes I'll get a little bit of pushback from traders in our private forum. They'll say, why is it that it doesn't make sense, Walter, that the market would be going up if all these traders are shorting it? Why won't the market go down? Everyone's selling it. Well, first of all, retail traders are not everyone, right? We're like the fly on the back of the elephant. So the elephants, the banks, the funds. We are the fly. So retail traders, I don't even know what the number is now. I know it's increased. I think maybe it's 2 or 3% of the volume of Forex in the world would be retail. I don't think it would be any much more than that. I don't know. It could be wrong. But retail speculation does not move the markets, right? Instead, what moves the markets are the banks, and and they look at key levels. They definitely look at key levels. They also like to spike it and get better prices and things like that. There's a lot of sort of manipulation there as well. We could talk about that in an entirely different webinar, but for right now, I just wanted to point out that you can see what's likely to happen during a trend simply by looking and seeing what the retail traders are doing. These data, by the way, are updated every 20 minutes. So I just hit the refresh and you can see they slightly changed. But let's say, when do I think the Euro-Aussie uptrend is going to fizzle out? Well, when this number gets down below 70%, I would think, yep, perhaps that's the case. Perhaps that's what's going on here. Perhaps if it gets down to 70, or 65, 66%, I'm saying, okay, maybe we're going to go into consolidation here. Doesn't mean the trend's over and it's going to turn around and go the other way. It just means that the strength of the trend is over. So this is almost like a strength of trend tool as well. However, I would caution you, and here's why. I'm actually in a short on the Aussie yen too, I think. Let's see, Aussie yen. Yeah, there's a little short on the Aussie yen too. But the most important thing here is that you will sometimes see the numbers look really good on the ratios, but that doesn't mean that you should take a trade. So, for example, the Swissy right now, what's the Swissy? The Swissy right now is at 71.8 and the yen is at 71.7 or whatever. But if you look at the numbers, you say, okay, yeah, let's go ahead and short the Swissy because everyone's going long the Swissy. Hold on, let me just make sure. Yeah, everyone's going long the Swissy and long the yen, and so you say, well, I'll go ahead and short it, but like I need to have both here because the downtrend on the Swissy has been so this retracement has been so extended. At this stage, for me, I'm not shorting the Swissy right now. I would wait for the market to actually break below this trend line before I would short it. Now, if it did do that, I would also look to take profit, at least some profit down here on 92.80 or so. 92.90, 93 even, right around there, where we found this support down here. That's what I would do on that one. So I would not take it just because of the numbers, right? And same thing here with the so the difference with the Euro Aussie was I had the numbers in my favor, and I also had a really nice level of support likely to come into play. But with the Swissy and the yen, I only have the numbers. I don't really have anything else to hang my hat on. I don't have a really nice level. So again, the yen here, everyone's going long the yen. I think what's happening here on the yen, you might be able to make the case for a squeeze play. We talked about the squeeze play, right? So this could be what's going on here. Maybe we're touching this. We've hit it 1, 2, 3, 4 times. This would be kind of like a double touch here. I would count these two as 2 touches. So we've hit it 4 times this support level. So if it breaks down and can close below this low over here, which is at 105.24, if it can close below there on the daily, then I would be willing to short the yen as well. Because remember, the yen numbers are pretty good too. They're above 70%. Traders are going long. The yen is actually a lot nicer than the Swissy. So, okay, any questions, guys? We're all clear on this one? Sweet. Alrighty then. Well, hey guys, I really appreciate your time. I hope you have a wonderful trading week, and looking forward to seeing you in the next Naked Forex webinar. I really appreciate your time. Have a wonderful trading week. Take care. Thanks, guys, for your time. I really appreciate it. See ya, Dinda. Bye, guys. Have a good one. Thank you. Take care. Thanks. Bye.